Brian, you sound pretty bullish in the note. So can you tell me how bullish are you compared to, say, 6 months ago? I'm just curious.
Same amount of bullishness.
Same amount of bullishness.
Here's why.
All that
same amount of bull.
We could take that a whole different way. And how much time do we have? Here's what I would say. This market, we as investors, we can't wait to call the end of the market. For the last 6 months, we've had people come out and say, this is the price peak for the year. This is the earnings peak for the cycle. A recession's coming tomorrow. This imminent demise of the market, we think, is way overblown. Now, there's not to say that there's excess volatility in the marketplace, especially given the fact that the stock market in the United States, as by the S&P 500 last year, was up 21%. So you're going to see a period of consolidation, something that technicians talk about, okay, like Chris. However, from an earnings perspective, I fall back to what, I'm just going to keep it really simple. The earnings in America, are, in terms of our companies, are the most stable asset in the world with respect to equities, period. And in times of volatility, you seek stability. So I still think we have the best companies in the world. I still think that a lot of what's happening is really default to the negative side of things. And then just one more other quick comment. We think in such binary fashions, Melissa. So what do I mean by that? Correction equals contagion automatically, right? Tariffs equal trade war automatically. I think there's somewhere in between that. So let's just take a deep breath, default to fundamentals. Earnings are going to be great in the second quarter. For second quarter, earnings are going to be great. The markets, we think, will continue to go higher.
I get that, but the earnings that we got last season, they were not a catalyst for the markets. I mean, after the S&P 500 declined from its highs in January, Chris, we've pretty much been in a trading range. So I'm wondering, from the chart standpoint, do the charts look better or worse than they did, 5 or 6 months ago?
Well, I think it depends where you look, and I'm thinking about 2018 as a pause year.
Okay.
And what really strikes us...
The whole year is a pause year.
Yeah, and I think if you go back and you look for similarities historically, where you've had very strong earnings in a market that makes no progress, a year like 94 or 84, you can think of where you had earnings up 20, the multiple contracted, and the following year was very, very good for stocks. What I think is notable here, the bar for a surprise in the back half of the year has been lowered meaningfully here. Investors are bearish, clients are bearish. The last week, we had the put call data absolutely spiking. So you've seen a big surge in put volume recently. I think that sets the stage for some type of positive surprise as we move into the back half of the year here.
I don't know the exact statistic, but I remember as an analyst and strategist in 1994, 1994 was a bad year. And the majority of the gains in that year happened in about an 8 to 10 week between kind of early November to the end of the year. And that really kick-started the Nifty 50, America, big cap, and really ushered us into this age of Greenspan's speech in 1996 of irrational exuberance. Everybody thinks now it was about tech. No, it was about big cap American companies, especially consumer staples companies. I think we're heading back into that type of scenario where U.S. is going to be so head and shoulders above from a fundamental perspective. And I think the number one thing people are missing is that PEs are going down this year. We have a cycle that the majority of investors have never seen, that PEs go down because earnings outpace price. So we could see some consolidation. Earnings are great, and I think that's very, very positive for the longer-term health of the market.
That's absolutely right. And if you think about 94, we were 2 years off a market low, 91, 92. Earnings were plus 20, growth was plus 4, multiple contracted 2 or 3 points. 95, S&P's up 25%, right? So it was the pause year or the reset year, particularly from a valuation standpoint. The other similarity, there was no safety trade that worked in 94, and there's really been no safety trade that's worked this year. Staples have been indifferent at best, REITs indifferent, utilities indifferent. You've been better off owning small caps and micro caps than you've had owning defensive groups. That's an important.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.